Final accounts of manufacturing business, Msamati manufacturing. IGCSE solved past papers with explanation. Paper code 0452 MJ17, May-June 2017. Msamati manufacturing, question number 4. The question is, the financial year of Msamati manufacturing ends on 31st January. All summarized details of their manufacturing account are given to us. Prime cost is 5,05,650. Factory overhead total is also given. Change in work in progress is given to us. Opening and ending work in progress difference is this one, which is subtracted from cost of goods produced. So it shows that the ending work in progress is more than the beginning work in progress. Cost of production finally calculated by their manufacturing account is given to us. Requirement is the theoretical part in the question that says explain the meaning of the term prime cost. The answer is cost which can be traced to a product or the cost of the essentials necessary for production. It could be the total of the direct material, direct labor and direct expenses. The sum of these three will always give us prime cost. Question B, part 1. Explain the meaning of the term factory overheads. The answer is the cost involved in operating the factory or indirect expenses are termed as factory overheads. They cannot be directly linked with the product being manufactured. Part 2. Suggest 2 items which may include in the factory overheads. The answers is any specific factory expenses such as factory indirect wages or the factory rates or depreciation of factory machinery, etc. State the meaning of the term work in progress. Goods which are partially completed, goods which are partly completed, goods which are incomplete are termed as work in progress. Part 2. State whether the closing work in progress was greater or smaller than the opening work in progress. We had seen in the previous slide, changes in work in progress are being subtracted from the cost of goods produced. We know that opening work in progress is added and the ending work in progress is subtracted. If the final change is being subtracted, it shows that ending work in progress was more than the beginning work in progress. Therefore, our answer for this question is the ending work in progress is greater than the beginning work in progress. After completing these questions, let's move to the part B. Part D. Msamati manufacturing's details are given to us. We are supposed to prepare the income statement for the year ended 31 January 2017. Their revenue is given to us. Purchases of finished goods, which is used in cost of sales portion, is given to us. Commission received, that is their other income, is given to us. Administration and selling expenses will be used by us in their expenses portion. Inventory of finished goods on 1st February 2016. This inventory is actually the beginning inventory of finished goods to be used in cost of sales portion. Office equipment, delivery equipment, both are given at cost. For income statement, we need to use them while calculating their depreciation. Previous provision for depreciations of these non-current assets are also given. Loan from a loans received on April 1, 15,000. This is the date on which we had taken this loan. It could be important while calculating interest for the loan. On 31st January, the finished goods inventory is this, that is the ending inventory. Commission still outstanding or to be received is 130. So this commission receivable should be added with the commission which is already received, because both of them will give us the total other incomes. Loan interest percentage is 5%. This means 5% is to be applied on this amount, and then we have to see for how many months the loan interest is not paid. During the year, the owner of the business took finished goods costing $16.20. So these are the reductions in the finished goods inventory which we should be showing in our cost of sales portion. Depreciation policy for this year: on equipment 15% using straight line method, on delivery vehicle 25% using diminishing balance method. Let's start working on income statement for Msamati manufacturing. Let's start with the revenue. We'll write the revenue here and we'll work on the cost of sales portion. Cost of sales portion always starts with the opening inventory of finished goods, which is given here. Cost of production, which is given to us in the question, is this one. We'll be using this cost of production because we are preparing the income statement of manufacturing business, and the manufacturing business income statement cost of sales portion always shows the cost of production along with the opening inventory of finished goods and purchases of finished goods. These three will be added and give us this answer. The closing inventory of finished goods and the goods withdrawn by the owner for himself will be subtracted from this amount. After deducting these two from this amount, we will finally get the cost of sales. Revenue minus cost of sales always shows gross profit. In gross profit, the other incomes are to be added and the total of expenses should be subtracted. In other incomes in question, we are given the commission received. That commission received along with the amount which is still outstanding will be added to give us the exact incomes for Msamati manufacturing. Then comes the expenses portion. All the expenses given in the question, administration, selling, interest expense and depreciations, will be listed here. Loan interest is calculated by applying the rate of interest on the loan amount from April 1 till January 31. 10 months is the duration for which interest is due. So we will be multiplying this interest by 10 months and dividing by 12 to find out the exact interest due on the loan. Depreciation equipment is calculated by straight line method. Depreciation delivery equipment is calculated by diminishing balance method, which says cost minus accumulated multiply by 25% is the depreciation amount. The cost of delivery vehicle is given to us as 68,000. Previous depreciation will be subtracted. This amount is 68,000 in the question. 68,000 is the amount, and finally we get profit for the year. Like, share, subscribe.